Welcome to the True Wealth Investors Real Estate Podcast. Creative investing strategies to help you build true wealth. I'm your host, Chad Harris. All right. So I'm glad to have you back. As always, appreciate it if you subscribe to our channel on YouTube, on Apple Podcasts. Leave us a rating and review. Any comments you want to leave, I love hearing from you, and am here really to help. So if there's some way I can help you, there's a question I can answer for you, I am glad to do it. All right. Always glad to have you back and see you here. One of our core beliefs is that we invest in real estate to create our dream life, right? That too many people I see, and I feel like a common trap for entrepreneurs is that they build a business that ends up running their life. And so this business is taking 56 hours a week. And usually, as entrepreneurs, we kind of wear that as a badge, like we're really hustling, we're really working hard, we're doing great things. And then whatever time is left over, that's the time we try to live and enjoy time with our family and do all the things that actually are most important to us, right? When we get to the end, none of us are going to reminisce fondly about all the hours we worked. But when we're in those last days, we're going to reminisce about the time we spent with family and friends and the memories we shared and the impact it made. And so I focus on the opposite, right? What is the life I want to build? What is the life I want to live? And I encourage you to do the same. How do you want to spend your time? How do you want to spend your days? And then build a business to support it. Okay. And so today's episode, I'm all about creativity. I don't believe financing should ever be a hindrance to you. When I started, I had no way to finance deals and yet was able to build a rental portfolio that supports my life. All right. The life I want to live. When I want to take off work, I take off work. When I want to work, I work. And I have really total flexibility in my schedule, which is a massive blessing to me and my family and my friends. And it will be for you. If you haven't achieved it yet, it will be. So keep working at it. All right. So today's topic, it's a recording from a teaching I was doing recently, and I was kind of going through different ways to finance real estate deals and the pros and cons of each. All right. So listen to that and pretty much choose what's the best thing for you. Now, I'm going to give you a little tip here. Some of the things that seem the most non-traditional and maybe seem the most difficult to learn are going to be the most rewarding. All right. But enjoy the recording. As always, send me any comments and questions, and we'll see you next week. Keep building your dream life one door at a time. Okay. How to finance a property. All right, so obviously we could use that big lump sum $500,000 we've got sitting in our bank account to fund all our deals. But even if that were the case, sooner or later we're going to run out of money, right? If we're going to actually, and I'm guessing most of us don't have that. So it's really beneficial to figure out other ways to finance the property. So but no matter how much money we have sitting in a bank account, sooner or later we would run out of money. So some options, your most traditional would be to go to a bank and get a loan, or and that bank is going to require uh, what credit check, tax returns, uh, all kinds of documentation. I tried to refinance my house one time. This was years back. I was probably 5 years in as a real estate investor, and my accountant still used paper. And so I had this stack of papers that was like a foot and a half thick. and just a miserable process. And of course, the banker didn't understand real estate, wasn't real estate focused, and that was horrible. So a local credit union is going to be a little bit better. It's going to be a similar process, but they're going to actually, usually they're looking to build a relationship with you. You're not just a number um, on that loan application. And so it's beneficial if you can build a relationship with a local credit union, and then they'll lend to you based on you and the deal, but over time they'll kind of give you, what would be the word? They'll, like, they trust you, and so the deal becomes less important. I had one where I had done one loan with this local bank, and then I was doing another loan with them, and I had kept money in the bank, which helps them, and made my payments all on time. And so the appraisals came back on the second loan really low, and I was ticked, and called the guy up and said, "Man, we've got a problem with these appraisals. These numbers are insane. There's no way the valuations of these properties are so low." And it was great because we had that relationship. He said, "Yeah, I looked at it. I thought the same thing. We're gonna go ahead at the valuations we said we were going to use." So they basically disregarded the appraisal. Um, so that's beneficial. DSCR lender we talked about, that's going to be a bigger lender that's lending on the asset. A hard money lender, um, a hard money lender is someone who is a professional lender. They lend on the asset, and they only lend short term normally, and they're gonna pay you. You're gonna pay a higher rate for the access to money. So let's say a bank loan is going to be 6%, DSCR lender is 7%. A hard money lender is they'll usually put their rates in points and interest. So it's going to be 3 points and 12%, or 5 points and 15%. And so a point is 1% of the loan value. So if you get a $100,000 loan and it has 5 points, even though your loan is for 100,000, you will only actually receive 95,000. So it's kind of like an upfront fee. So if you talk to a hard money lender and they say, "I lend at 3 and 12," then they're referring to 3 points and 12% interest. And then so most of their money for a hard money lender is made on the points. So you want to try to get that lender to be close to a year. So 12 months, 11 months, something like that. If a hard money lender is really trying to crank up their profitability, they're going to go to 6-month notes or even 3-month notes, because you then have to pay the points every time you extend that note.
Mm-hmm.
And so if you're at, let's say, just round numbers, 3 points and 12% interest, and it's a 1-year note, then that's essentially 15% interest. But if it's a 3-month note and that deal goes for a year, then you have 3 points times 4, which is 12, and the 12% interest. So you're at 24% interest. So
Wow.
yeah, so the length of the note will drastically change your cost. But if you're doing a flip, or you've got some really great deal that is short term that you'll either sell or can refinance, a lot of times it's still worth it, right?
Mm-hmm.
If you're going to pay them whatever, let's say $10,000, but you're making 35,000,
Mm-hmm.
well, hey, that's all right, right?
Mm-hmm.
Okay, now the another alternative is a private money lender. Private money lender is someone who isn't a professional lender. They're pretty much somebody, usually somebody that you would know, that invests in the stock market, or a CD, or mutual funds, something like that. And they usually don't know that they can be a lender for real estate. And so we can explain to them how it works and how they can be a lender in our real estate deals and all the security they get. And in most instances, it's really beneficial for them. And so with private money, you're going to pay no points. And then the interest rates usually are somewhere in the 6 to 8% range, sometimes 10. But 10, you're usually by 10, you're getting into like a real estate investor who's looking for a return on their money. A true private money lender is going to be 6 to 8. And if you offer 10, that's going to scare them because any stock that pays a 10% dividend is like that's insanity and super high risk.
But
So
if you're benchmarking it against the S&P 500, right? And if I'm in the stock market and I know that the average yield on the S&P 500 index is 8 to 10%, right? So if it's private money and I want to get my toe wet and I'm saying, okay, what is my opportunity cost? If I stay in the S&P 500 index, I'm 8 to 10%, right? So I want to benchmark against the S&P index. So I'm between 8 and 10%.
you could be, and really, if you borrow money between 8 and 10%, that's not bad, right? That's much better than hard money. But if you're actually talking to a private lender that has money in the stock market, every single one of them has heard their financial planner tell them diversification is a good thing.
Mm-hmm.
It's what you should pursue. And so you should follow one of their plans for spreading their money across stocks and bonds and cash. And across that portfolio now, you're going to get anywhere from 5 to 9%, right? Depending on how much you're putting into bonds, how much you're putting into stocks. So usually, if we're paying 6 or 7%, that's actually going to bump up their return. That's better than they're going to get elsewhere.
Mm-hmm.
And then once they near retirement, their financial planners tell them to expect 4% in retirement.
Mm-hmm.
We're willing to pay much higher than 4%, right? 4% is, where you're pulling most of it out of the market because of the timeline. You can get that 10% in the stock market as long as you're willing to leave it in, right? If there's a bad year, you may have to leave it in there quite a few years to get it back. So you can very easily rationalize 6 to 8% for them,
Okay.
and it's beneficial to them. And then, like we talked a little bit about, your seller can be the one to finance a property, and that's a really good situation. If it's an investor, they like the monthly payments. That's why they had the rental, but they're tired of tenants and toilets. And so you can step in and be the new owner that deals with all the problems, and they still get them a monthly check. So, I know we talked about questions on finance. What do you got, Andre?
Yeah, well, one quick question that popped in my mind. Well, I got a few questions because I don't have the money.
Yeah,
But
shoot.
the first one is with these hard money and private money lenders, how do these deals typically look? Like, will their names pop up on the deed temporarily, or are they? How do they? I guess I don't know if y'all want to say secure or make
Yep.
sure that how do they protect their investment?
So yeah, any hard money lender or private money lender almost always will have a mortgage just like a bank, or just like any of the other lenders. So their name's not on the deed, but the mortgage is recorded is tied to the property and recorded with the county so that it's in a title search. And so they have first position. So let's say So the way it would work, let's just walk through each one. A hard money lender let's say they're going to lend you the purchase and rehab, and the purchase is 50 and the rehab's 20, and you're going to sell the property for 100. Let's just say for round numbers. They're lending on the deal, not as much on you. So you're going to present the deal to the hard money lender. They see the potential in the deal. They think you're going to make money. And so they may lend you the full 50,000 for the purchase, but most likely they're going to want you to have skin in the game. So maybe they'll lend you 35, let's just, or 40, just for a round number. So you need a little bit of money in the purchase. And then they're going to expect the rehab will be on a draw. So if it's a $20,000 rehab, maybe you have to do $5,000 of work, and then they inspect it, and then they refund you 5,000, and you do 5,000 and they refund you over until you get the rehab done. And so they would, once the rehab's done and you have listed it for sale with the realtor, let's say they have 40 from the purchase and 20 from the rehab, they have $60,000 lent on the property. You have $10,000 in the property. And then when it sells for $100,000, the title company sees that lien from the hard money lender. So the sale of the property would pay the realtors, it would pay off the hard money lender, and then you would receive what's left. Does that make sense?
Yep.
Okay, awesome. If it's a private money lender, it's really similar, except private money lender doesn't have all the restrictions, and like they usually don't have a draw cycle or anything like that, right? They're trying to compare it to a stock investment, and you're the one presenting it to them. And so usually a private money lender really doesn't want to be involved. They don't like the idea of multiple draws and money going back and forth. So it might be that they lend you 50, you purchase the house for 50. If they haven't worked with you yet, maybe you do the rehab and then they lend you the other 20, and then they get paid back at the sale. Or if they've worked with you a bunch and they trust you, then they would just lend 70, you use 50 for the purchase, 20 for the rehab, and then at the sale they get paid back.
Okay.
If you're doing, let's say you're doing the BRRRR strategy because you want to have a rental instead of a flip, then hard money lenders sometimes don't do rentals, but if you get one who does do a rental, um, and private money lenders do like rentals, that's no problem. But it would work in a very similar way where you get the money for the purchase, the rehab, but then instead of selling the property, you're going to refinance the property with a bank or a DSCR lender. And when you refinance, that pays back the hard money lender or the private lender, just like a sale would.
Got you.
Hard money lenders always short term. Private money lenders can be long term. And so I actually like doing where I don't have to refinance. I'll just fund the whole thing with a private money lender, the purchase, the rehab on the front end, and be a 10-year note with that lender. And I don't have to refinance. I can leave it there. So private money lending, lenders, you can get more creative. So
Gotcha.
hopefully that's not too detailed. Any other questions on like the differences or why you would use one over another or anything like that?
Um, I guess I have another question along those lines. You mentioned, when you got started, you kind of jumped straight into private money. How did how'd you do that from coming from, almost no real estate? I don't know if you had real estate experience prior to that, but if you didn't, how'd you convince that private money lender to invest in you?
Yeah, that's a good question. Um, so the two things I had going for me, One was I was used to raising money for ministry because I was working overseas in Kenya, and I had to raise all the money for that work for everything we did there. So I had raised close to $1 million for that. And so I had learned the hard way over pitch and pitch and pitch how to present so that they are super excited in ministry to donate. And those skills perfectly translate to how to present the opportunity to a lender so that they are really excited to lend money. So I kind of knew how to do that. And my parents had rentals. So even though I had no I mean, even though I had no experience in investing in real estate, I had grown up working on rentals, right? I really didn't know anything about the financing side. Um, but I think people, I guess, associated that I somewhat knew about rentals. I'm not really sure. That's a good question, Andre. Um, for my coaching clients now, if they have no experience, then I recommend they borrow somebody else's experience, right? So they put on their credibility kit and they tell everyone that the coach I am working with or my mentor that I'm working with has raised millions of dollars, has managed 80 units. And so similar to, I think people probably saw me and said, oh, well, he grew up working on rentals. Well, my clients, the people they're talking to may say, well, they're not used to real estate, but the mentor that they're working with knows real estate. So that's the best way to borrow somebody else's experience. Other than that, I would say which you talk about other ways you have done what you say you're going to do and fulfilled your commitments, right? So most people I was talking to in those early days, they knew what I had gone through living overseas. And so there was no doubt that if I said I was going to do something, I was going to do it, right? If I borrowed money from them and I said I was going to pay them back, I would either pay them back or die trying, one of the two. And so a lot of it is convincing them of that fact. What have you done in your life that you have made a commitment and stuck to it? When have you gone through difficulty? What did you learn in it? How did you prove that you can go through difficulty? Right? I know that's probably a really abstract answer to the question, but it's with private money, it's more a relationship and it's not a loan application that you can just check a box. We are adding new episodes every week, so make sure and subscribe and check out all of our content at truewealthinvestors.com.